Hi, ladies and gentlemen. Welcome to the Expat Chapter, the Blevins Franks podcast, where we seek to answer the questions that you didn't even know you needed to ask. This is the fifth in the version of our Expat Chapter. Now, last week we discussed property, which prompted a raft of questions about capital gains tax, which just clearly lots of people very confused about, especially from a cross-border perspective. So, Tom, can you give us an overview of capital gains tax rules and capital gains tax in the UK?
Yeah, I can. Relatively straightforward now, actually, since the last budget. So 18% is the prevailing rate for basic rate taxpayers and 24% for higher rate taxpayers. It's as simple as that. You've also got a capital gains tax allowance in the UK. A lot of people lose sight of the fact that when they move to France, they don't get a capital gains tax allowance, but you do have that in the UK, at least for the time being.
And that's reduced in the last few years, yeah? It was quite a lot higher than it is now. It's now reduced. So I think it was about 12,000 and now it's down to about 3,000, yeah?
Correct. Yeah, not very generous.
Yeah. So it's obviously a direction of travel is that it's probably disappearing. All right. Thank you. James, can you give us a view from a French perspective?
Yeah, so in France, we need to distinguish the capital gain, so whether it's a property capital gain or from an asset. So the property will be taxed at 19%, with a surcharge of up to 6%, depending on how much gain there is to be made there. Whereas with investments, it's a bit more simple. There is just a flat tax of 30% historically, which is made up of a 12.8% income tax, or capital gains tax rather, and a 17.2% social charge. But as of the 1st of January this year, that has been increased to 31.4%.
And France also applies exit tax, which is a deferred capital gains tax, for want of a better way of describing it. Can you just explain what that is, and can you see that being applied to people leaving the UK?
So what France do is they try and protect a gain that's been made well in France. So if you trigger this exit tax, you can pay taxation on the assets that you have, even if you've actually not realised the gain. There is a deferral period. So it's quite a complex rule, but basically what they're trying to do is protect people from generating gains in France and then leaving and not kind of paying France their dues. It's something that has definitely been discussed in the UK. There's more and more people leaving. I mean, we're benefiting from this. We're seeing that the affluent Brits looking to leave the country, and there's been numerous mentions of an exit tax potentially coming into the UK. At the moment, there isn't one, but it's definitely high on the radar, given the amount of millionaires kind of leaving the UK at the moment.
I suppose in a way, extending the overseas transfer charge to UK pensions if you leave is a form of exit tax. So maybe that's definitely a conversation for a future podcast. So Tom, the $1 million question that most people are asking is it better to be taxed in the UK or France from a capital gains tax perspective?
Well, as I mentioned earlier, you don't necessarily have the choice. It's governed by the treaty, but where you do have the choice is if you change your tax residence. If you're moving to France, as James alluded to, if you're in a position where you've got the S1, your capital gains tax top rate is going to be 20.3%, combined with social charges, which may be fairly similar. If somebody's selling UK assets, it may be fairly similar to the liability that they would experience in the UK. I think where France gets really interesting is in terms of investments over the long term. There are structures that you can use as a French resident that will really nullify the effect of capital gains tax over the long term, and it effectively means that people can enjoy a tax-free growth, tax-free gain on their assets, which is then really quite favourable, especially if they later then move back to the UK. So I suppose the point I would make is that there's a lot of tax planning that can be done if somebody moves cross-border, and that is certainly true when it comes to France.
Okay, all right. James, it feels like tax and social charges on both sides of the channel is getting worse. Is that a fair statement?
Yeah, I mean, it's definitely the direction of travel, isn't it? So yeah, there are more things happening in the UK and France as well. But it's vital that you kind of keep abreast of these changes. So doing some planning, looking how you can mitigate these taxes. Quite often we see that people moving to France, they think it's a high taxation country, but actually, if you organise things efficiently and structure things properly, you can be paying significantly less tax in France than the UK. Another benefit that we have down here in our area as well, for people looking to exit businesses and various different things like that, they can transition through to Monaco, so something we're calling kind of tax tourism. There's not just Monaco, you can go to various different places, but structuring multi-jurisdictional kind of advice is something that we're doing from time to time if the kind of situation is right, and it can be done. So there are lots of different things that you can do, and it all revolves about getting that planning at the right time and not just looking after the fact.
I suppose it also emphasizes the fact that you need to keep on reviewing your situation on a regular basis.
Yeah, for sure. I mean, there's even clients that I've taken over in the last kind of couple of years. The tax rules have changed in such a short period of time. We're having to review what I set up only a couple of years ago. So yeah, that's where that ongoing advice and communication comes in. It's a back and forth. It's not just us telling them what they should be doing as clients, but also they should be kind of having communication with us, what they're looking to do, has anything changed, and it's a relationship that continues over time.
Tom, how can people reduce the tax specifically on their investments?
Okay, well, I think the first thing to say on that is what people shouldn't do. So people who are moving to France shouldn't necessarily retain UK investment structures, because in doing that, they could be walking into a tax liability that they could easily avoid. What we often encourage people to do is actually to restructure their assets before they move to France. James mentioned a couple of episodes ago about assurance fee, which is a very widely used type of investment structure here in France. Lots of people use it, including the native French population. And it's really useful, really powerful when it comes to capital gains tax planning, because effectively, once you set it up, all of the gains accumulate tax-free within the structure. So if you're making trades on a portfolio, you're avoiding capital gains tax. Now, compare that to an investment portfolio that sits outside of assurance fee. If you're making trades, if you're making changes from one investment type to another, or one shareholding to another, then that could potentially be taxed at 31.4% every time you're realizing a gain. So assurance fee is really good on that side. But as we discussed in another episode, assurance fee is widely used as well for inheritance planning reasons. So it really is quite a powerful, and I would say quite a central planning tool when it comes to French residents.
Okay. So James, if you're planning to leave France, should you sell your assets, your property, your investments before you leave or after you've left?
Well, from a property perspective, if we look at French rules, you've got 12 months to sell the property with no capital gains tax liability, as long as it's not been rented. So as long as you don't rent it between the point where you leave France and you sell it, you have a 12-month window. So it makes sense, ideally, from a financial perspective, to sell that property within that time. You then need to look at the rules of where you're going. But with the changes that kind of, my computer's crashed. Oh no, it's DAS has crashed. Sorry, I have to start that one again. It depends where you're going, really. So if you're going back to the UK, this is a real common one for us at the moment. We've got lots of people contacting us looking to go back to the UK, and actually it makes great financial sense to do so. With the changes to non-dom rules, and now we have long-term non-residents and long-term residents. For people that are later in life and going back to the UK, if they've been living out of the UK for over 10 years, their first 10 years when they return to the UK, they have no inheritance tax on overseas assets. So for those types of people that are contacting us, it makes sense to sell different investments and then keep it overseas. So one thing we can do as well to benefit and maximise this kind of transition period is use something called time apportionment relief in the UK. So the UK, when you're a UK resident, will only tax the gain you made while you've been in the UK. So if you've had an investment for 10 years and you've only lived in the UK when you encash it, you'll only pay 1/10 of the gain. But it's actually done on a daily basis. So if you've had the policy for 10,000 days and you've only been in the UK for 1 day, you pay 1/10,000th of the gains. What we can see is people can go back to the UK with huge gains in various different investment portfolios, such as Assurance V. they can close it down when they return to the UK and pay little to no taxation on it, and then we can restructure things for inheritance tax purposes, and depends on what their kind of situations and objectives are when they return to the UK. But yeah, there's a great advantage there for returning to the UK and in cashing the investments when they arrive.
Tom, we shouldn't be surprised now when there's a change of political situation in the UK. The last 5 years, that seems to be the norm. But potentially the latest change, do you think that could drive big changes come the autumn budget in the UK?
I think it could. I mean, if we just put aside what's going on at the moment in UK politics, I think the trend, as we discussed earlier, the trend across the world now is for taxes to increase. There are lots of countries around the world that have a black hole financially. The UK is one of them. So I think it is reasonable to expect that UK capital gains tax will increase one way or another. We're recording this at the end of June in 2026, and we know that the incoming Prime Minister, Andy Burnham, we know his views on capital gains tax. He has very publicly said that he believes that gains on investments, property gains, should be taxed in the same way as income. So what could that mean for investors? Well, it could mean that gains are taxed at the same rate as income tax rates, which is up to 45%. So I think we would encourage anybody who has UK assets, if they're living in France, to really consider what they're doing in terms of whether retaining those assets or whether selling them is a good idea, because I think you're right that things could change quite quickly.
So the political situation is probably not much better in France, James. Macron looks like he's going to hang on now until the end of his term, and obviously then there is going to definitely be a change at the Élysée Palace. Do you see much change happening in France, or will the French populace reject it?
Well, yeah, if anyone's been reading the news over the last couple of years, it's been quite difficult to get a budget through with the current situation. But yeah, as you say, Macron's trying to cling on grim death till the end, really. But it is more difficult, it seems, in France to get anything through. So it has to be ratified, it has to be accepted. And then the French love to strike as well. And so they get involved, as we saw with the Yellow Vest movement a few years ago when they looked to change pension rules. It does seem to be a little bit more challenging from the French side, but the direction of travel is the same as the UK: more taxation, more onerous, and trying to generate revenue where they can. So no, I don't think it's too different to what's going on in the UK. But again, whether you're in the UK or whether you're in France, you need to just be planning and keeping an abreast of the situation, to not just kind of leave it all to potluck as to how it affects you.
I think one of the big things that's come out of today's podcast is the fact that things are changing, and they're changing quite rapidly, and they will continue to do so. So, ladies and gentlemen, thank you for joining us for the 5th version of our Expat Chapter. Like and subscribe us wherever you download your podcasts. If you want to know more about Blevins Franks or any up-to-date information, you can find us at www.blevinsfranks.com. And next week, join us again, because we're going to talk about visas, immigration, and the dreaded exit and entry system. Thanks very much for joining us. Look forward to seeing you soon.
Goodbye.
Goodbye.